to another CISI Level 2 Fundamentals of Financial Services session. And this week we will be looking at bonds, and we will be focusing on an introduction to these types of financial instruments and some of the terminology that fits around those. So we finished last week on looking at the equity section. So this is a brand new chapter and a brand new element that we'll be looking at starting from this week. And I'm joined by another special guest this week, but this time it's Simon Metin, a relationship manager from the London Stock Exchange Group. Welcome, Simon. Nice to have you with us.
Nice to be here. Thank you.
Brilliant. And if you could kick us off with a bit about who you work for, what you do, and how you've got to where you are in your career, that would be fantastic.
Sure. So currently I work in the London Stock Exchange Group within their Information Services division. And I'm one of the relationship managers for the various products that we have within this division, with a focus on our fixed income products. So this naturally ties into the bond segment that we're going to discuss now. But we offer our clients a multitude of different products within fixed income, whether it be data, indexes, or analytics. And these products are really utilized by clients worldwide, and it gets me involved with a lot of clients. I'm currently focused on the European side of things at the moment. But with the nature of the business, this can extend to America, it can extend to the Far East, so on and so forth. Aside from the fixed income side of things, I'm also working alongside our sales managers for the multi-asset products. So that includes the equity offerings, the real estate offerings. We're currently looking at infrastructure offerings, for example. And given that London Stock Exchange Group very recently acquired Refinitiv, which is a big data supplier, we are really looking to expand our capabilities within all of these regions. So it's a really exciting time to be working at LSEG. And in terms of how I got to this point in my career, it's quite a convoluted story, but I actually studied to become a doctor in university. I actually went to Cambridge, where I earned a medical degree in both medicine and surgery, alongside a master's in pharmacology. And the way that the Cambridge course was structured was very much preclinical medicine for 3 years, and then you go onto the wards for the last 3 years. And I loved the way the first 3 years went. I loved learning about it, but then in the last 3 years, I didn't really find working as a doctor to be what I wanted. So within that time, I had enough time to really think about where I wanted to go, what I wanted to do, and finance was something that really appealed to me. So I decided to do a couple of internships at small businesses, and then I ultimately decided not to start the foundation year program for medicine. And from that, I then went into an internship at Bank of America Merrill Lynch, where I was ultimately offered a job, but then LSEG was offering something that was more client focused, which, even though I didn't want to become a doctor, working with clients was something that I enjoyed doing anyway. So I moved into LSEG and started in their client services division, where I learned about our products. And then as I sort of went up the learning curve, I moved more into relationship management and sales, which brings me to where I am now. Like I said, a bit of a convoluted story, but it just goes to show that if you do want to do anything, you can do so. And, right now I may not have any client financial qualifications, but I'm actually doing a couple on the side while I'm working as well. So there is a lot of scope for learning after school.
That's fantastic. What a story. We've had a few interesting stories of people's career pathways that wouldn't be seen as the traditional way to get into financial services. And it's great, as you say, different routes open to you. And just because you're not necessarily studying economics or business studies at university or in school doesn't mean that it doesn't mean that you can't be in working financial services at some point. Can I just ask, Simon, what skills would you say that you currently use that may be nicely transferred across from when you were studying to be a doctor and your time at university?
Yeah, sure. I mean, there's a ton of transferable skills. I mean, although you shouldn't really look at your patients as clients, they ultimately are, and you do learn a bunch of communication skills. There's actually whole units dedicated to speaking, how to speak with people, how to garner information properly, letting the people ultimately tell you what they want, which is a very important skill when you're working in sales and relationship management. But then also, with medicine, you're going to be used to long hours. You're going to be used to really grinding hard to learn material, to understand product sets, to really go that extra mile for clients. And that's something that I have been doing. That's something I've been spending a lot of my time doing. You may be contracted to work 9 till 5, but then there are some days that I clock off at 9 p.m. because clients in America need something, or there are some days where I log in at 5 a.m. because there's something going on in Asia, and you obviously need to be awake for that time of day. And then there's also things like time management, organization. If you're ultimately not organized as a doctor, then your patients suffer, and trying to negotiate your way around a day, fitting things in where they should be and prioritizing things that should be prioritized. It can really pay its dividends at the end of a year when you've realized that you've taken full advantage of the time that you were given.
Yeah, sure, absolutely. Well, it's really fascinating to hear about your story and how you've got to where you are at the moment. And it sounds like with the opportunities on offer, the sky is the limit, Simon.
Of course, yeah, always.
Absolutely, brilliant, excellent stuff. That's what we like to hear. Positivity, fantastic. Right, if we without further ado, we will get on with the content and have a look at this. So, the objectives of this session is basically to look at understand what a bond is. So, define a bond and the reasons that they are issued, and we're going to look at who issues them, the key features of bonds, and we're also going to identify and know the meanings of the key terms that are associated with bonds as financial instruments. So the pre-session task that you were asked to complete was a little exercise that involved you writing an IOU, which back in the day, a long time ago when I was at school, if we used to borrow money off of our friends, we used to write a little note out for them. That was an IOU to say, right, well, I owe you £1, £2, whatever it was. I'm sure nowadays that probably doesn't happen. But what the task was for you to write an IOU based on the fact that you'd lost your travel card, you needed to borrow £10, and you needed to use that money to purchase a new travel card for the day. Now it says your friend was hesitant that you might not return the money, so that's why this IOU, or this contract, if you like, was put in place. And the task asks you to write down what you would include in the IOU. So what factors or what items you would actually include on that piece of paper that you had written to your friends. So we're not going to go into this and use this exercise as a basis, but this really, once you've watched this session, it kind of then reflects some of the things that you might have written on that IOU, and it relates very nicely to bonds. So come back to this activity after you've watched the video and just check about the things that maybe, or check the items that you've written on that IOU to see if you've got the right, you're on the right lines. So the first thing, Simon's going to be a bit of it's going to be a bit like mastermind. Lots of questions about bonds. So I'll be the Magnus Magnusson, Simon. So I'm probably about as old as him. So first question really for you is, can you tell us what a bond is?
Yeah, sure. So, I mean, at its fundamental level, like you mentioned with the IOU parallel, a bond is very much it's a security, a financial security that enables an institution, whether it be a company, whether it be a government, to borrow money. And this borrowing obviously has a set of terms attached to it. And this within the terms, it will say when that money needs to be paid back, so a defined period of time. But also for the given the fact that the person who's lending you the money isn't going to be doing it for free, they're going to want something in return. And the way that you get that return is through interest. And this interest can either be paid at installments throughout the life of the bond, and then at the final point of the bond's life, you get the final interest payment and whatever you lend it out, or the interest can be given at different points in the bond's life. Given the nature of fixed income, it can be very, very varied. But like I said, at its fundamental level, it's just going to be you getting interest payments throughout the life of the bond.
Right, so we're basically talking about a form of a loan, aren't we? If
Exactly.
In all honesty, yeah, it's governments or companies borrowing money,
Exactly.
or raising capital through borrowing, to do whatever they want to do with that. And yeah, fantastic. So just another question on that, when we go onto the slide here and just kind of summing up the definition, as you said, they're debt instruments or securities. Why is the term fixed used, Simon? Why fixed interest or fixed income is also the other term used?
Yeah, I mean, back historically, bonds used to be very simple. You would you'd lend the money out, and then throughout the life of the bond, you'd be getting interest payments. And it used to be that the interest rate was fixed, and therefore, based on, say you loaned out $1 million, and you were offering a 3% interest rate on that. Throughout the life of the bond, you'd be getting 3% interest payments at fixed intervals. So that's where the term fixed income came about. However, since then, the financial markets have really evolved quite substantially, actually. So there are a multitude of different bond offerings now, whether it be floating payments, so it can float off of a given index. For example, we have something called LIBOR, which is it's an interbank offering rate, and this is something that varies. If, for example, you look on a bank's website, you might see interest variable, AER, and that is akin to the floating rates that you might get given on a bond. And then, you can go so far as having inflation-linked bonds, which change according to inflation, or you can even have something called step-up bonds, in which the interest rate steps up at a set amount or even a floating amount throughout the life of the bond. So although fixed income is historically being used, it's not necessarily a definition that's fit for purpose nowadays, but it's still being used.
So it's a traditional definition that
Exactly.
As things have become more sophisticated and new products have been, or new financial products have been developed, and as you say, the old bonds would have had this interest rate that wouldn't have changed, but now you've got these, as we say, variable rates of interest. And it's really good that you've spoken about indices as well, because we spoke about stock market indices in the previous session, and also used the consumer price index and the retail price index as example of indices that work in a similar way, and do a similar job, if you like, but just measure inflation rather than share prices. So yeah, it's useful to know that. And things like LIBOR, we've spoken about the Bank of England base rate. So Simon mentioned LIBOR, the London Interbank Offered Rate, which, correct me if I'm wrong, Simon, but I believe that's the rate of interest that banks lend to each other. Is that correct?
Exactly. Yeah, that's interbank. So it's the rate at which banks lend to each other. And the reason why it's important is because if a bank is going to lend you money, they've got to consider their borrowing costs as well. So borrowing costs are normally above what the LIBOR rate is, so that they can make a profit.
Right. Excellent. Thank you. Great. Fantastic. So up on the screen there, we've got the definition, which includes a number of the items that Simon mentioned there. So it's talking about a bond being basically a debt instrument or a loan that is made, and as we said, by a company, and normally a large publicly listed company, or a government, and they borrow money rather than going to a bank, and they borrow for a defined period of time, whether that's 5, 10, 15, 30 years, whatever that might be. There even used to be bonds that were known as perpetual bonds that never had a date in which they had to be paid back, and they were often used to fund wars back in the day. But I believe UK government has settled all of those up now. I think all of the perpetual bonds they had.
Yeah, but there's still a lot of others internationally.
Right. Okay.
And it's interesting that you the picture on screen that you have, those were called bearer bonds, and it's purely because they were literally pieces of paper where the bearer of that piece of paper was entitled to whatever the interest rate and the amount at the end of it.
Yeah, and it's the reason I put that up there is for exactly the reason that you've just spoken about there, Simon. Because when we were talking about shares and equities, we were talking about the transition or evolution from paper-based certificates over to electronic trading of shares, and the issues that come with having paper-based. So as you said there, that's a bearer bond, if you like, which was that physical certificate that you had that showed that you were the bondholder. And I'm sure these still exist somewhere. People have probably still got them hidden away somewhere in attics and things like that. But the interesting thing, which we'll come back to, are the 4 kind of rectangular slips at the bottom, and that will relate to something we'll talk about a bit later. We'll talk about the interest that's paid on a bond and the term given to that, and that relates to these four pieces of paper underneath 4 segments underneath that main bond certificate that you can see there. So we'll come back to that. Excellent, thanks, Simon. So moving on, you've already kind of mentioned this, but who are the main issuers of bonds, Simon? I know you kind of mentioned that when we spoke previously, but
yeah, sure. So I mean, the general purpose of issuing bonds is to get large amounts of money, and the entities that really need large amounts of money are the government to fund all of their offerings, whether it be developing infrastructure within a country, whether it be education, the NHS, all of these things. The money needs to come from somewhere, and then you've got the really large corporations that need large amounts of capital to fund their operations, whether it be ongoing operations, whether it be expansions, whether it be mergers, acquisitions, all of those kinds of things. Because it's considered an expense when they're paying it back, it's a tax efficient means of raising the money as well, which is why they consider it an alternative to raising money through stock, for example.
Right. Okay. Yeah. And I mean, most big PLCs will tend to do both anyway, won't they?
Exactly. They'll tend to do both, and that's because there's really an optimal mix of equity and debt that a company can issue, and that's done through very complicated analysis by their business analysts. But that's definitely a conversation for another time.
Yeah, we do. We start to towards the end of this chapter, we look at leverage and the impact of the amount of debt to equity in a company and that kind of thing, and the balance, getting that balance right for a company. And so we will come on to that in a few sessions down the line. But yeah, it's a good point to raise. So as Simon said, really you've got 2 main issuers of bonds: large companies, PLCs, those listed companies that would issue shares via stock exchanges. So we call those corporate bonds, and then you've got bonds issued by the government. And Simon has spoken about reasons why the government may do that. And we've got a couple of examples here of which might help as we go through this session to understand why companies might issue bonds rather than going to a financial institution to borrow money. So this is an example of companies issue bonds quite a lot. Governments issue bonds quite a lot, but Microsoft here made a bond issue in November 2012. They raised $2.25 billion through that bond issue. And if you cast your minds back to when we looked at investment banking, investment banks probably would provide advice to companies like Microsoft about bond issues and how they go about raising finance that way, as well as the advice they would have given them about carrying out an IPO or an initial public offering or a rights issue for new shares. Equally, investment banks will offer advice on bond issues as well. So it may well have been that one or several investment banks were behind this this bond issue for Microsoft. But what it involved, the bond issue involved 3 different groups of bonds being sold that repaid the money at different dates. So Simon spoke about the term of the bond, the amount of time that the bond is in issue, okay, before it is repaid, before that money that's been borrowed is repaid. And also they all paid different rates of interest. And Microsoft issued the bonds. They were a little bit vague, but they said they wanted to purchase other companies. So there was, as Simon mentioned, about a bit of mergers and acquisitions were involved here, which was part of the motivation for issuing these bonds and borrowing that money. And they also wanted to pay off other more expensive loans. So they wanted to consolidate some of their debts, probably because issuing these bonds was cheaper for them. The interest rate was probably lower. So they borrowed this money via bonds to do that. And when we said they issued 3 types of bonds, at the time when they issued them, the 3 types of bond were all based on the duration of which they were in issue, so the term of the bonds. So we had a 5-year bond, 10-year bonds, and 30-year bonds that were issued, and also the interest payments, or what we will come to know them as coupon rates. But the interest payments here were different for each type of bond. So you can see they issued $600 million worth of the 5-year bonds at 0.875% interest, 750 million worth of the 10-year bonds at 2.125% interest, and $900 million of 30-year bonds at 3.5% interest. So they issued a total of $2.25 billion dollars worth of bonds there. 3 different types, different terms, different amounts of time or maturity dates or maturity lengths, and different interest payments. Question, Simon, why would the different bonds have different rates of interest?
Sure. So, I mean, if you're a money lender and you are looking to lend Microsoft, in this case, money, you're going to be thinking about what you're going to be getting in return, because ultimately your Microsoft are going to have to pay for that money alongside just giving you the money back. And there are a number of we call them premiums associated with lending that money, and that's really related to the risk that you are incurring for lending that money out for a given amount of time. And like I said, the base rate of risk is really the I mean, LIBOR is an example. That's considered the risk-free rate that you're going to be lending at for anything. And then above that, it's really the other associated risks that come with issuing bonds. So one thing that you're going to be thinking about is the credit risk, the risk that Microsoft will not be able to pay you back for any unforeseen circumstances. I mean, if you're looking at these amounts at these different different time periods, Microsoft is more likely to undergo a significant problem in the next 30 years compared with the next 5 years. So there's a credit risk associated with that. And then you've got other premiums. So like one thing I mentioned was the term premium. You're having to undergo an inconvenience for not having access to $900 million for 30 years. So you want a return for that. But then there's also there are other premiums that you can consider, like liquidity. And that's really how easy it would be to sell that bond. And it's far easier to sell a bond that's 5 years away from maturity than it is for something that's 30 years away from maturity. So all of these different premiums really add up to the end interest that you're going to be looking at, and that's what you really consider to be the risk that you are incurring, and the return that you are demanding.
Yeah, thanks, Simon. Yeah, and we to cast students' minds back one of the earlier sessions when we spoke a lot about risk and reward. When you're looking at investments and understanding that relationship between risk and reward, that the higher the risk, the higher the potential level of reward that an investor would expect in return for taking that risk. And as Simon mentioned, there's a number of reasons why those interest rates would be different. But the one we point out here is the point that Simon made, that in 30 years there's a stronger possibility that something might happen to Microsoft as a company than potentially in the shorter term 5-year, 10-year period. So therefore the investor is taking more risk and they need to be compensated for that risk. And as Simon said as well, the fact that then an investor can't access their money for 30 years because they won't get it repaid until that point, unless they were to potentially sell the bond on, then obviously that risk also has to be factored in. So that's really useful, Simon, to talk about that. It's not just the time period. Actually, there's other things to bear in mind there as well. Fantastic. Excellent. Right. So that's an example of a corporate bond there. We've also got an example of an issue of government bonds. And again, government bonds are issued quite frequently. You might recall that we spoke at length about the difference between capital market instruments, bonds and equities, so bonds and shares, and money market instruments, which are almost short-term versions of bonds. But you don't need to know about that for this qualification, but something to bear in mind. Governments and companies can borrow money through shorter-term borrowing debt instruments, if you like, which we would refer to as money market instruments. But in the case of bonds here, the UK government issued bonds. This is an example from 2015, and we've got up there UK gilts. What does a gilt refer to, Simon?
Well, a gilt refers to a UK government bond that's issued by a UK government, and I think again, there's a lot of historical reference in the nomenclature of bonds, and in this case, I think gilts are so called because they had gilded edges, so they were sort of gold around the edges when they were, in paper form. But I mean, why would a government need to raise money? And it's really casting minds back to the balance between, what the amount that government is spending versus the amount that they're getting back. And the only way that a government can earn money is through taxes. So you've got to consider the balance between these two. And if government spending is greater than the taxes that they're receiving, they need to then issue bonds, in this case gilts, in order to equalize the difference.
Yeah, absolutely. Yeah, so it's that, as you say, whatever the UK government priorities are for spending. I mean, interestingly, we're going through strange times with COVID, and the government's having to borrow huge sums of money to fund furlough schemes and keep the economy moving while people aren't able to go to work and to stop people losing their jobs. So yeah, we're at a time where government borrowing is kind of an unprecedented level. So interesting in that perspective. But as you say, the government brings money in through taxation. The likelihood is that they won't earn enough tax in taxation to fund everything that they need to spend their money on. So therefore, they need to borrow money, and they do that through the issue of bonds to do that. And we've got another example here. 2015, UK government sold £1.75 billion worth of treasury gilts, and as Simon said, a gilt is the term used for a UK government bond. It's kind of the nickname that's given to it. And as Simon said, it's because the original bond certificates that the government issued had that kind of gold edging around it. So they were known as gilt edge securities. And the bonds paid the borrowed money back in 2034. So there were quite a lot of bonds that were paid back in a number of years, quite quite a long duration, and they would pay 4.5% interest each year on those bonds. So it's just another example of where government bonds have been issued, comparing that to corporate bonds, as we saw with Microsoft in the previous slide. So coming to the next thing to ask you, Simon, is why would a company, or why would money be borrowed via bond issues rather than going to, say, a bank, for example? What would be the reason behind that?
Yeah, sure. I mean, there's quite a few reasons, and I mean, one of the things that I mentioned earlier was that, you know, companies and governments, they use bonds because they can raise huge amounts of money. I mean, we're talking about billions and billions. And if you go to a bank as a big company, no matter how big you are, a single bank is not going to lend out billions and billions of dollars because they just don't have that much money. And I think if the financial crisis taught us anything, banks becoming over leveraged, in which, you know, they have too much debt, it is you know, it's never going to be a good thing. But if they were to then issue bonds, and, you know, investors were the ones who were going to foot the bill, they can really have access to an unprecedented amount of money. The other thing is that if you go to a bank, no matter what kind of loan you are looking to take out, there are very fixed rates at which a bank is willing to lend you money. I mean, they can issue at fixed rates, they can issue at variable rates, but normally it's the bank dictating what rates they're willing to lend at. The good thing about bonds, like I mentioned earlier, that they are becoming incredibly flexible in the terms and conditions. So there aren't just fixed rates anymore. There are variable rates. There are rates that float off of different indexes at different spreads to that rate. Spread meaning the additional amount of interest that you have to pay it above that rate. There are inflation-linked bonds. I mean, there are even bonds that float off of stock prices. And then there are, like, I mean, you can have, like I said, step-up bonds, in which interest steps up at predefined amounts. So a company can be, I mean, they can be inventive to a certain degree as to how they pay the money back, but it just means that they can pay back money more attuned to how they want to do it. And then the other thing to consider is they can be cheaper in some circumstances. I mean, issuing a bond is slightly more expensive than you know, doing the paperwork to get a loan, but you can ultimately achieve slightly lower interest rates than if you were to borrow from a bank directly.
Thanks, Simon. Brilliant. So absolutely, just kind of summing up some of Simon's points there, why money could be borrowed this way. So as we said, you're going, rather than going to a financial institution with a bond, you are going to investors. So you are borrowing money from a number of different institutions or people rather than going to one financial institution. And with that, as Simon said, sometimes it can be cheaper and you can borrow money at low rates of interest. But this, the idea that you've got much more control over how you borrow your money is something that's quite appealing, especially to large companies. So you can make multiple bond issues, as Simon was saying. That you know, we looked at the Microsoft example there, where they borrowed money with different rates of interest, and also they had to pay it back at different over different periods of time. So again, it gave flexibility to them around how they borrowed their money. And the point that Simon made around the bank's requirements, they normally have kind of quite rigid set requirements of a borrower, and therefore a company, if you're borrowing through bonds, you don't have to worry about that because you don't have to abide by their stricter rules or stricter procedures. So gives much greater control and freedom. And also, as Simon spoke about, the risk that one financial institution or a bank is unlikely to start lending out the billions of dollars or pounds that companies are looking to borrow. You know, you can borrow huge sums of money, as Simon said. So one financial institution is unlikely to be able to take that much risk on and lend those sorts of sums of money. So the other route that companies have, and what governments do as well, is they will lend via bonds where they can spread the borrowing across multiple different lenders because they are selling those bonds to a wide range of different investors. Thanks, Simon. But that just kind of sums up why a company might borrow and a government would borrow money this way rather than potentially going to a financial institution, a bank of some nature. So the last kind of area to look at is the key terms that are associated with bonds, and we've kind of mentioned a few of these as we've been going through here. But we'll deal with these. So we'll pick Simon's brains for the meanings and the definition. So up on screen there, you've got a mock-up of a bond certificate. There's some information on this mock-up that you wouldn't probably see if it was a real bearer bond, a real bond certificate. But we're just going to use this. So Simon, we've got that kind of it says up there 5% treasury stock 2025. So treasury stock. So when you see a bond name, it's always got some sort of name in there, hasn't it? What sort of things? I mean, we've got treasury stock there, but what sort of things do you normally see?
I mean, in the case of a government, you'll typically see. In this case, treasury is more of a US focused thing, but in the case of other governments, you'll see the name of the government, or if it were a corporation, you'd see the name of the company. So yeah, like it says on the slide, it will be the name of the bond and normally the name of the issuer. And sometimes they can be shortened versions of the name, but ultimately it all goes back to whoever was the issuer.
So it's just an explicit way of telling you who you're lending money to, basically. Exactly. Yeah, it's a bit like on your IOU, you might put the name of the person that owes money and the name of the person that you owe money to. Yeah. Okay. Fantastic. And what in that title of the bond there, if you like, what does the 5% represent?
The 5% represents the interest or the coupon of that bond. And normally on a bond, it's quoted at an annual rate. So in this case, 5% would be the annual rate of interest on that bond. If interest was paid on an annual basis, you get 5% back every year at a predefined date. If interests were paid semi-annually, which is normally the case for a lot of government securities, then the interest will be split in half throughout the year. So you'd get 2.5% at one point in the year and 2.5% at the other end of the year. Like it says again on the slide.
Going back to the slide where we had that picture of the bearer bond on there, and I mentioned the 4 kind of rectangular slips at the bottom. So as Simon said, this is known as the coupon, which is the other term for the interest rate that's paid on the money that's being lent. So the reason they're called coupons, if my memory serves me correctly, relates back to that picture where you had what looked like 4 rectangular
coupons.
Slips. Yeah. So they were, so they used to, when you had the bearer shares, they would tear those off, go to a particular location and trade them in for their coupon payments.
Exactly. Yeah, and actually one of the things also on the slide is the coupon is based on the nominal amount, which is the amount of money that has been raised, not necessarily the value of that bond, which is an important distinction to make.
Yeah, absolutely. And we'll in the next session we'll be looking at bond prices and how they change if you're looking to trade them. I mean, that's another important point to make, isn't it, about bonds? And actually, one of the similarities there is to shares, if you like, is that they can be traded. You don't have to just keep a bond until it matures. You can sell it, and you can buy it before it matures. And there might be several reasons why that might happen. But as you say, the original value of the bond when it's issued is what the lender will get back at that maturity date.
Exactly.
But the price of the bond, if it is sold before it matures, may be higher or lower than that nominal amount of money.
Yeah.
It's and that's a difficult concept to kind of, I think, to get your head around for people that don't work with these all the time. It's kind of okay, so how does the price change? So we'll be looking at that in a bit more depth in the next session. And then we've got our redemption or maturity date there, Simon. So we've already spoken about that, and we've already kind of said that this is the date where the nominal amount of the bond, so the amount that the bond was bought for originally, the value of that bond at that time, that is repaid in full. So again, if we're comparing this to bank loans, normally with bank loans, you will pay the money back in regular monthly installments that tend to be agreed with how you're borrowing money. With bonds, you don't have to pay that amount back until the bond matures. So if I borrow £10,000, I don't have to split my £10,000 repayment over 5, 10, 15 years, whatever that might be. With a bond, when I hit that maturity date, which in this case is 2025, I have to pay back the full nominal amount of money. So that's quite good for a company, because they can then plan, can't they? That they know what they're doing. They know that at that date they need to pay this chunk of money back to the investors.
And actually, one of the interesting things that some companies do is, as the bond approaches maturity date, they actually issue another bond in the amount that they have to pay back. So that's called rolling over the bond to the next date.
Right. So if okay, so they just issue another bond that covers that one off, and they're still borrowing the money. Yeah,
exactly.
Sure. Okay, so a bit like remortgaging your house kind of thing. Okay, excellent. Right. So the redemption date, as we said, or maturity date, is that date when the bond is repaid in full. So that nominal amount of money that the bond was initially purchased for, and the amount that the bond was worth at that point in time, that's paid back to the borrower. Sorry, to the lender. Sorry. The other thing we come to there, Simon, we've got on the screen there, is that what we've mentioned there about the nominal value. So on this bond, it says £10,000. And as you said there, that's the amount that the bond was worth when it was first issued. And that's the amount that they get back.
Yeah, I mean, it's the amount that the company raised. In this case, the company needed £10,000, and that's how much they raised, and that's how much that ultimately needs to be paid back, and is how the coupon is also calculated.
Yeah, sure, absolutely, fantastic. And then actually coming to now, this I don't believe would normally appear on a bond certificate if with the old bearer shares, but we've got the price of the bond there. Do you want to tell us a bit about how bond prices are shown, Simon? How they're kind of communicated? Or
I mean, so in this case, you're seeing that £10,000 was issued, but the price is only 101.25. And the reason for that is because the price, again, this is really historical. The price is calculated per 100 of the nominal amount. So in this case, the price is 101.25, which, if you compare it to 100 nominal, it's 1.25 above that. So you'd actually call that bond a premium over its nominal amount. If it was, say, 99.25, then you'd say that bond is calculated at a discount to its nominal amount. And then if it were 100, you'd say that bond is par priced, which, as you can see on the slide where it says nominal / par / face value, it's akin to its par amount, which is the amount that it was when it was issued. And there are a multitude of reasons as to why the price of the bond can differ from its nominal amount. I mean, this all goes back to the idea of risk and return. And if for example, interest rates were to suddenly go down, this 5% bond would be worth more, because you're getting a higher interest rate, and therefore it would be priced at a premium. Yeah, it can be confusing at times, but then a bond can a bond's price can be different from its nominal amount.
Yeah, it's a really good point to make, and we'll kind of reinforce that again next week when we look at why bond prices can potentially change if they're traded. Yeah, as Simon was saying there, kind of the tradition is to quote a bond price of how much it costs to buy £100 nominal of the bond. So when its first issue, as Simon said, it would be priced that you need to pay £100 to buy £100 worth of the bond, which makes logical sense. If you go into a shop and that's the price, then that's what you pay for it. But then things can happen that might affect the price of that bond. So therefore, as Simon said, in this case, you've got the £101.25 is the current price, which means the price of the bond has gone up. And therefore, the value of that bond, if it was traded now, would be £10,125 rather than the £10,000 nominal. But it's always important to note that it's always the nominal amount that the lender will get back when the bond matures. They won't get the £10,125 that it's valued at now. They will get the £10,000 nominal, which was the amount that was borrowed in the first place. So we'll look at that in a bit more detail next week. But that's really useful to know. Thanks for that, Simon. It makes sense it does make sense to know that now as we go through, because the pricing piece then makes a little bit more sense. Right. Okay. Great. Simon? Is there anything else that you wanted to raise about bonds that we haven't mentioned as we kind of come to an end of the session?
No, I mean, as you progress into like the pricing of bonds, a lot of things will become clearer. I think it's just worth to note that the world of fixed income has changed dramatically since the times that they were issued on certificates. I mean, yes, a lot of things are becoming electronic now, and it's coming to the point where the more liquid fixed income securities, such as treasury bonds from the US government, they're even being traded through algorithms, which are automated, things done via a computer. So the face of fixed income is definitely changing. It's becoming a lot more in vogue because I mean, the world of equity has become increasingly unstable. Yes, things are going up, but equally, investors want something to turn to if everything were to, turn upside down. And alongside that, the fixed income world is evolving to, match this investor demand. So, things like I mentioned about bonds changing, like inflation-linked bonds, for example, but then you've got the really complicated securities, such as mortgage-backed securities, and these are bonds that aren't like your typical bonds. They are related to a load of mortgages that a bank issued, for example, and a bank will then issue a mortgage-backed security, which is actually backed by all of these mortgages that you and I are paying. So they can be as complicated as you like, and it can be really interesting to learn about as this industry evolves.
Yeah, that's I mean, the mortgage-backed securities were obviously infamous in the credit crunch
In the credit crunch, yeah,
recession. Yeah, absolutely. Yeah, so you're right, and yeah, there's all these different types of bonds, and I mean, we can mention about the fact that pension funds love bonds because of the certainty that they provide, especially things like index-linked bonds that increase in value as inflation goes up, which obviously protects the value of the investment. So, yeah, I mean, the thing to talk about bonds, talk about risk and reward, and the fact that, as Simon says, equities are very volatile in nature in terms of their price, but also dividends aren't always paid. At least with bonds, you've got a kind of greater degree of certainty that you will receive your money back unless something happens to that company or the government defaults on its debts. But the certainty is there. But as a result, because the risk isn't as high, probably the returns may not be as great.
Yeah, aren't as great as equity. That's for sure.
So it's an interesting conundrum. But you say, yeah, pension funds, bonds are very popular with pension funds because obviously they want certainty because people need to retire
Exactly.
they need that money there. But they will also have a balance of shares, bonds, and
Yeah,
some
I
other
mean,
things in
like
the
like
pot.
all companies would, and it's interesting you mentioned pension funds as an example. I mean, the gilt, the issuance of gilts. Pension funds are heavy buyers of gilts, especially the really longer dated maturities, and they buy so much that the interest rate on the extreme 30-year gilts is actually lower than the say 10-15 years, because it's all about supply and demand as well. So if there's a huge demand, it can actually cause the interest rates to dip. So the UK gilt curve is quite unique in the sense that it goes up and then down.
Right. Yeah, interesting. Excellent. Well, thanks so much, Simon. It's been fantastic to have you here. It's been brilliant every session we've had. But you've given us a great deal of insight into bonds here, and really thank you for your expertise on that.
No worries.
I'm just going to finish up by just saying to students that there's another multiple choice test on the classroom there. There's also some videos on the classroom summarising some of the things that we've spoken about in terms of bonds, the definitions, looking at, there's a video on government bonds and corporate bonds that you might want to have a look at, as well as the slides here. So it's just for me to say thanks very much for watching. And Simon, again, it's been an absolute pleasure. Really appreciate you taking time out of your busy day to spend some time with us. Thank you so much.
No problem. Thank you.